This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the intense dual pressures currently facing the global market.
It's a really complex setup.
It is. So our goal here is to really cut through the noise and look at two converging risks. First, this enormous, and I mean enormous, $20 trillion ripple effect from the yen carry trade unwinding.
And second, this cash flow crisis that's really starting to hit the AI sector.
Exactly. And then we'll tie it all together with the critical technical levels for the S&P 500 and the NASDAQ, especially after that interesting liquidity injection from the Fed.
It's an exceptionally volatile setup, you're right. The timing just couldn't be worse. You have these huge global macro risks just smashing into scheduled domestic market volatility.
The financial perfect storm, basically.
It really is. A major decision from the Bank of Japan hitting at the exact same time as the largest options expiration day in history.
Okay, so let's start with that macro time bomb. It's ticking right now. Tonight, the Bank of Japan is widely expected to increase its interest rates.
By just 0.25%.
Yeah.
0.25%.
Which sounds incredibly small on paper. I mean, it's almost nothing.
It sounds like a rounding error.
Yeah.
But this isn't about the number. This is a huge mechanical shift. It takes their rates to the highest level since, 1995.
And it's all about leverage, right? The psychology of it.
It is entirely about leverage.
Mm-hmm.
Specifically, the infamous yen carry trade. For over 2 decades now, Japan has been this global outlier.
Keeping rates near zero.
Near zero, or even negative since 2016. And what this did was, it turned the yen into the cheapest funding currency on the planet.
So in simple terms, massive hedge funds and banks could just borrow yen for almost nothing.
For free, essentially.
And then they take that money, buy U.S. assets where they can earn, 4 or 5%.
That's the key arbitrage. You borrow for free, you buy U.S. treasuries, U.S. stocks, crypto, whatever, and you just pocket the difference.
But the scale of it is what's terrifying. The estimated exposure is over $20 trillion.
It's an almost unimaginable number of borrowed yen just sloshing around the global markets. That's why it's a systemic risk.
So when the Bank of Japan raises rates, that free money, that cost of borrowing the yen, it suddenly goes up.
And that immediately triggers the reverse carry trade.
Meaning everyone has to deleverage.
Exactly. They are forced to sell the assets they bought. Could be the S&P 500, could be Bitcoin to get yen, which they need to repay those now more expensive loans.
And this isn't like a choice. It's a mechanical forced selling.
Which is why a small rate hike from Japan has such a violent impact globally.
And we've seen this before. I mean, the data is pretty clear. Past Japanese rate hikes have been brutal for risk assets.
Yeah, we've seen Bitcoin drop, 24%, 30%, even 29% after these kinds of moves.
And even earlier this year, a minor policy shift from them led to a 6% drop in the S&P 500. So it forces volatility.
And that volatility is just being amplified by the timing. Tomorrow is set to be the largest options expiration day ever.
OPEX day. We're talking over $7.1 trillion in notional options exposure expiring.
And for anyone who doesn't know, notional exposure isn't the price of the option. It's the total value of the underlying stock the contract controls.
So it's the real dollar value at stake.
Exactly. And about $5 trillion of that is tied directly to the S&P 500 index.
Mm-hmm.
So when market makers have to unwind their hedges against all those expiring contracts, it just creates this massive mechanical churn.
Which leads to sharp dips and bigger swings.
Yes, so you have scheduled domestic pressure on top of this external yen pressure.
So a $20 trillion yen tremor meeting a $7 trillion OPEX earthquake. That definitely sets a tone.
It does. But we did get a positive countersignal today, which was all about liquidity.
Right. The U.S. core CPI inflation data came in at 2.6%.
Which is the lowest level we've seen since March of 2021. And that reading is, theoretically extremely positive for the market.
Because it gives the Fed more room to cut rates down the road.
For sure. And it definitely sparked a nice rally in the S&P this morning.
But there's a big asterisk next to that number. Yeah. One of our sources suggested this data might be, let's say, under scrutiny.
Absolutely. You have to include the caveat. The recent government shutdown limited the Bureau of Labor Statistics' ability to fully calculate all the month-over-month price changes.
So the data might be skewed.
It might be incomplete, which makes the January 13th inflation report just critical. We need that one for a cleaner picture.
And speaking of the Fed, they also stepped in on Friday. They injected $40 billion of cash into the system.
Using short-dated treasury bills. And the wording was important. They described it as liquidity creation, not recycling.
Which sounds a lot like quantitative easing. I mean, they're creating new money.
It is. It's what we'd call tactical QE. It's not a big long-term stimulus program. It's surgical. It's designed to manage immediate cash flow stress inside the banking system.
Okay, but if the banks need 40 billion in emergency liquidity, isn't that a bad sign?
It raises questions for sure. But the interpretation is that the Fed is acting proactively. They're trying to manage the stress before it becomes a full-blown crisis.
So they're getting ahead of it.
That's the theory. And historically, when the Fed does these quiet injections, that liquidity often supports the market and can start, these quiet multi-month uptrends.
Okay, so while the Fed is managing banking liquidity, let's look at why money is flowing out of the AI sector.
Right. And the simple summary is that the bill just showed up. The huge, long-promised bill for building the future just arrived.
And Wall Street is shifting its focus from just growth to show me the money, show me the free cash flow.
The problem is CapEx, capital expenditure. I mean, building the infrastructure, the data centers, the servers, the power needed to run all this, it's astronomically expensive.
You saw that with Oracle. Their spending plans exploded. They're projecting up to $50 billion in future CapEx.
And what was the immediate result?
A negative $10 billion in free cash flow, which is a huge red flag for the market. It means cash is just pouring out of the business faster than it's coming in.
It's the same exact problem facing OpenAI. They have these huge partnerships, but the costs are just staggering.
The numbers are wild. Potential costs of $250 billion for Microsoft Cloud rent, $38 billion at Amazon.
And the power they need. We're talking 36 gigawatts. That's the power requirement of a small country just to run their models.
And their revenue model is reportedly struggling to keep pace.
Which is making investors very nervous. And that nervousness was perfectly captured by the reaction to Broadcom's earnings.
Right. They had a great report overall, but then the CEO said something about OpenAI.
He said the revenue from OpenAI wouldn't be meaningful until, 2027 to 2029. And the stock just dropped 11%.
So the market is saying we will not wait 3 to 5 years to see a paycheck from this.
Exactly. And this really illustrates the AI cash cycle for you. There are 4 phases. Phase 1 is massive spending. Phase 2 is building the infrastructure.
Then phase 3 is monetization, and phase 4 is margin expansion.
And right now, we are stuck deep in the transition between phase 1 and 2, the deep cash burn stage, which is the most uncomfortable part for investors.
And that's why the money is rotating out. Okay, that's a perfect setup for our technical analysis. Let's pivot to the charts, starting with the S&P 500, the SPY.
On the weekly chart, the S&P is still in a bullish uptrend, which is good. But the critical level, the line in the sand for the bulls, is 675.
And that's a point of what you call confluence. What does that mean here?
Confluence just means several key support indicators are all clustered right there. At 675, you've got the 20 and 50 simple moving averages lining up with the 38.2% Fibonacci retracement level.
So it's a very strong floor of support.
A very strong floor. If the market holds above that, the structure is still strong. A little dip down to test it would even be healthy. The danger is if we break convincingly below it.
Okay. And in contrast, the NASDAQ, the QQQ, is showing more weakness.
It is. You can see the tech rotation there. The QQQ's 20 SMA is flattening out, which signals momentum is fading. It's already broken below that 38.2% fib level.
So what do the bulls need to do?
They need to immediately reclaim 628. That is the line in the sand for the NASDAQ right now. If they can't get back above that, we could see a deeper correction.
Let's quickly touch on a couple of big individual stock moves. First, DJT, Trump's stock, surged almost 40%.
Yeah, that was after they announced a merger with a fusion company, TAE Technologies. The hype is connecting fusion to future AI data center power needs.
But it's incredibly volatile.
Immense risk. That $15 level is going to be a major wall of resistance.
And on the opposite end, a total collapse in marijuana stocks.
Yep.
MSOS fell 27%.
Wiped out all the recent gains. This was a textbook buy the rumor, sell the news event. The reclassification to Schedule III is good, but it's not federal legalization.
So it fell short of the market's highest hope.
Exactly. And the market sold off hard on the news.
Okay, so pulling this all together, with the volatility, the Fed's actions, the AI crunch, what are the key considerations for you right now?
For AI, you have to think long-term, 3 to 5 year plays, and focus on companies that are already profitable, like NVIDIA and Broadcom. They can weather this CapEx storm.
And what about that yen risk tonight?
History says you have to be cautious on crypto assets, things like the ETFs IBIT or GLXY. If that carry trade unwind accelerates tonight, Those high beta assets could see very significant, very sudden drops.
But there is a silver lining, a historical data point that supports some optimism for a year-end rally.
Right. When we see these high volume spikes in the S&P 500 like we have recently, history shows the market is higher 100% of the time, 3 to 4 weeks later.
100% of the time over the last 3 years.
And the average gain is about 4.9%. So that data supports the idea that if those technical levels can just hold, the market has the internal strength to push higher.
So what are we watching tomorrow to test that strength?
We get existing home sales data 30 minutes after the open, Carnival Cruise Line's earnings pre-market. And then on specific stocks, watch Lululemon. It needs to hold 214 support, and Starbucks needs to get back above $90.50 to show any continuation.
Great. Let's quickly summarize the key takeaways from today's deep dive.
Takeaway 1, global volatility is peaking. You've got the largest ever options expiration converging with the Bank of Japan's rate hike, which could trigger that $20 trillion yen carry trade unwind.
Takeaway 2, the AI sector is facing a severe cash flow problem. It's all about huge capex spending, which is punishing companies like Oracle and shifting money into already profitable players like NVIDIA.
Takeaway 3, the Fed's $40 billion tactical liquidity injection, plus that positive core CPI data, is providing some much-needed short-term support and a potential base for stability.
And finally, takeaway 4, the technicals. The S&P 500 must hold that key confluence support at 675, while the Nasdaq has to reclaim 628 immediately to keep its bullish momentum. So here's a final thought for you to chew on. If the Fed is using tactical QE to solve immediate banking stress, what does that really say about the health of the financial system just beneath the surface? And if that $40 billion injection is the only thing standing against a potential $20 trillion yen unwinding, are we just watching a controlled deleveraging, or are we waiting for the Fed's move to be completely dwarfed by these massive global pressures? Something to ponder as you watch those markets tonight. Thanks for listening to the 15-Minute Investor.